If you filled up your car this month and felt a little sick looking at the total, you're not imagining things and you're not alone. Across North America, fuel prices have been climbing, refiners are scrambling, and at the center of the story is a relationship most drivers never think about: the pipeline connecting Alberta's oil sands to the refineries of the American Midwest and Gulf Coast. To understand why prices moved the way they did, and why American refiners are suddenly nervous, we need to start not in Canada but in the Middle East. In late February 2026, the United States and Israel launched military operations against Iran. What followed was one of the most disruptive stretches for global energy markets in decades. Iran's Revolutionary Guard responded by effectively seizing control of the Strait of Hormuz, the narrow waterway between Iran and Oman, through which roughly a fifth of the world's oil shipments pass every single day. Brent crude jumped to over $106 a barrel, while West Texas Intermediate climbed to nearly $94 as the strait remained effectively closed, cutting off about a fifth of global oil shipments. Iran rejected peace overtures from Washington, and its parliament began drafting legislation to charge ships for passage through the strait it claimed to control. Things escalated further from there. Brent crude eventually surged past $113 a barrel, with WTI breaking through the psychologically important $100 mark after President Trump issued a 48-hour ultimatum demanding Iran reopen the strait. Trump threatened strikes on Iranian power infrastructure if the waterway didn't reopen, and Tehran promised retaliation. Analysts at the International Energy Agency described what was happening as comparable to two 1970s-style oil shocks hitting simultaneously. Since the American and Israeli operations against Iran began in late February, Brent had rallied more than 50%, and Goldman Sachs revised its full-year 2026 Brent forecast upward from $77 a barrel to $85. This is the piece that a lot of casual news coverage misses. When people say oil skyrocketed, they're usually talking about a move from the mid-60s before the war to somewhere north of $110 at the peak. Depending on exactly where you draw your starting line, that's a jump in the neighborhood of 70 to 80% in a matter of weeks. It's the kind of move that doesn't just show up in trading terminals, it shows up at the pump, in trucking costs, in airline fuel surcharges, and eventually in the price of basically anything that gets shipped anywhere. Now, war premiums like this don't stay at their peak forever, and this one didn't either. As talks between Washington and Tehran produced a memorandum of understanding in June, prices eased back down toward pre-conflict levels. But the ceasefire proved fragile. Brent crude rose above $76 a barrel for the first time in 2 weeks amid renewed violence around the Strait of Hormuz, reversing a slide that had brought prices back to pre-war levels. Then came another flare-up. U.S. West Texas Intermediate rose 1.5% to close at $79.34 a barrel, while Brent gained nearly 2% to settle at $84.73 as the U.S. military launched fresh airstrikes on Iran and reimposed a naval blockade on the country's ports and coastal areas. U.S. crude had actually traded above $80 a barrel earlier that session as Washington and Tehran continued fighting for control of Hormuz. Just days later, in mid-July, the same pattern repeated. Brent crude climbed more than 4% as the U.S. and Iran traded fresh attacks over control of the waterway, with September futures reaching $78.82 a barrel, the highest level since late June. Within days, Brent had risen as much as 3.8% further, extending a 9.6% gain from the day before, pushing September futures to $85.92 a barrel, the highest level in a month. By that point, Brent had climbed 19% from its price before the U.S.-Israel war on Iran began in late February. So this isn't a single spike and done. It's been a jagged, repeated cycle of escalation, partial de-escalation, and re-escalation, all centered on whether tankers can safely move through one of the most important choke points on the planet. And every time tensions flare again, the whole system braces for another price jump. This is exactly the kind of moment the U.S. Strategic Petroleum Reserve was built for, and the Trump administration used it. In March 2026, 32 member nations of the International Energy Agency unanimously agreed to a coordinated release of 400 million barrels of oil and refined products from their reserves, with the U.S. authorized to release 172 million barrels from the Strategic Petroleum Reserve over roughly 120 days. That's a massive intervention. But here's the catch. The SPR wasn't exactly overflowing to begin with. The reserve can technically hold 714 million barrels, but as of late June 2026, it held only about 337 million barrels, less than half of its authorized capacity. And the drawdown accelerated fast. Between the week ending March 20th and the week ending April 24th alone, the Department of Energy released 17.5 million barrels, bringing SPR stocks down to roughly 398 million barrels. By early July, the numbers had gotten even more uncomfortable. EIA data showed the reserve had fallen to roughly 319.5 million barrels, its lowest level since the early 1980s. Government auditors weren't thrilled about it either. The Government Accountability Office flagged that the reserve has faced increasingly frequent and large drawdown orders, including the 180 million barrel release after Russia's invasion of Ukraine in 2022, and now this 2026 release tied to the Iran war, all while the SPR reportedly lacks a unified long-term restocking plan, has incomplete repairs, and aging wells. One energy outlet even noted the release was pushing the reserve dangerously close to its legally mandated operational floor of 150 million barrels. So think about what that means strategically. The U.S. just burned through a huge chunk of its own emergency cushion to keep prices from spiraling completely out of control, which raises an obvious question. If American shale oil and the SPR can't fully insulate the country from a crisis like this, who's actually keeping American refineries running? The answer, more than most people realize, is Canada. Here's the part of the story that connects everything back to those refiners. Canada supplied 63.4% of all U.S. crude oil imports in 2025, making it not just a trading partner, but a core pillar of American refinery supply. That's not a small number. That's essentially 2/3 of everything the U.S. brings in from abroad. And it's been climbing for years. U.S. oil refining capacity stood at about 18.4 million barrels a day as of January 2024, and in 2023, 60% of all U.S. crude oil imports originated in Canada, up from just 33% a decade earlier. Imports from Canada grew by an average of 4% every single year between 2013 and 2023, and by 2023 they made up 24% of total U.S. refinery throughput, up from 17% in 2013. But it's not just the volume that matters, it's the type of oil. Canadian oil sands crude is heavy and sour, meaning it's thick, dense, and loaded with sulfur. That kind of crude is difficult and expensive to refine, and most of the world can't handle it efficiently. Canada is largely unable to refine the majority of its own oil and must export it as unrefined, heavy, sour crude. But only a limited number of countries have the refining infrastructure to process that grade. Canada produces around 5.8 million barrels a day, but has only about 1.93 million barrels a day of domestic refining capacity across 17 refineries, forcing it to export the bulk of its production as raw crude. So where does it go? Overwhelmingly, to the American Midwest. Many U.S. refineries have specifically been configured with coking capabilities to handle the heavy sour crudes typical of Western Canadian production, and Canadian refineries have such limited heavy oil capacity of their own that Canada remains heavily dependent on the U.S. to refine these barrels. This is genuinely a two-way dependency, but American refiners are the ones with highly specialized, expensive equipment built around a very specific type of feedstock. Some U.S. refineries, like BP's Whiting facility with a capacity of 430,000 barrels a day, were specifically modernized with Canadian crude in mind. You don't just swap that out overnight for a different grade of oil. Retooling a refinery's coking units to run efficiently on a different crude blend is a multi-year, multi-billion-dollar undertaking, not a quick fix. That's exactly why analysts have pointed out that American shale, for all its volume, doesn't actually solve this problem. Shale oil is light and sweet, the opposite profile of what these Midwest refineries were built to process. Commodity analysts have noted that oil buyers in the Midwest are almost certain to bear the cost of any disruption to Canadian crude, given the limited substitutability between Canadian heavy oil and other available grades, which creates strong pass-through to retail prices. Of the roughly 6.6 million barrels a day the U.S. was importing in recent data, about 4 million barrels a day was heavy oil, specifically destined for upgraded refineries with cracking units. Heavy oil simply can't be easily substituted with the light oil that dominates U.S. shale production, because that kind of switch would create a massive loss of optimization in cracking units that are specifically designed to process the heavy residual left over from vacuum distillation. Put another way, Canada has effectively become the irreplaceable supplier for a huge slice of American refining capacity. Canada supplied almost all, roughly 99.89% of heavy crude imports into Midwest refineries over the past decade. When a supply relationship is that concentrated, any shock to it doesn't get absorbed quietly. It gets passed straight through to whoever's filling up their tank. Now layer trade policy on top of that dependency, because this is where things get genuinely uncomfortable for both sides. A 10% U.S. tariff on Canadian energy products has been weighing on Canadian crude prices, widening the gap between Western Canadian Select and West Texas Intermediate, the two benchmark grades used to price heavy and light oil respectively. That spread, known in the industry as the WCS-WTI differential, is essentially the discount Canadian heavy oil trades at compared to the American benchmark, reflecting transportation costs, quality differences, and how much pipeline capacity is actually available to move the oil to market. For a while, that discount had actually been shrinking thanks to new infrastructure. The differential between WCS and WTI is expected to average around $11 a barrel in 2025, helped by improved market access to Pacific ports and seasonal maintenance that temporarily reduced bitumen production. The big driver behind that improvement was the completion of the Trans Mountain Pipeline expansion. Since the expansion was completed in February 2024, the pipeline's capacity has been increasing from 300,000 barrels a day to 890,000 barrels a day, meaning Alberta shouldn't face the same transportation bottlenecks it has dealt with for much of the past 2 decades, at least for now. That's a genuinely big deal. For years, Alberta produced more oil than it could physically move, which forced Canadian producers to sell at steep discounts just to clear the barrels. New pipeline capacity to the Pacific coast gave them another outlet besides the U.S., which should, in theory, strengthen Canada's negotiating position. But tariffs cut the other way. Under a scenario where the 10% tariff on Canadian energy remains in place, the WCS price is expected to fall to roughly $45 a barrel in 2025, before improving to around $48 a barrel in 2026, as the tariff is assumed to gradually phase out. Under that tariff scenario, the price differential between WCS and WTI is expected to widen to $15 a barrel in 2025 before narrowing back to around $14 in 2026 and stabilizing near $13 for the remainder of the decade. In plain terms, the tariff eats directly into what Canadian producers get paid, even as American refiners keep buying the same volume of oil because they genuinely have nowhere else to get it. And this is where the leverage question becomes really interesting. On paper, it looks like the U.S. holds all the cards, it's the customer, it sets the tariff. But dig into the actual dependency numbers and the picture flips. As one of the largest suppliers of crude oil to the U.S., accounting for over half of American oil imports, Canada plays a genuinely crucial role in supporting U.S. energy markets and energy security. If the U.S. were to aggressively exert leverage over Canada in this relationship, it would risk inadvertently damaging its own domestic gasoline prices and industrial production. That's the trap. Washington wants cheap gas for voters, but the tariffs it's imposing on the exact crude that Midwest refineries depend on push costs in the opposite direction. It's policy working against itself. Meanwhile, Canada has been quietly diversifying where it can, using that new Pacific pipeline capacity to sell more oil to Asian buyers, including Chinese refiners looking for a discount alternative to sanctioned or geopolitically risky suppliers. That gives Alberta some breathing room, some ability to say, we don't have to sell everything to the U.S. anymore. But it's not a full escape valve. The infrastructure connecting Alberta to the U.S. Midwest, the pipelines, the specialized refineries on the other end, took decades and tens of billions of dollars to build. That kind of integration doesn't get replaced by a single new pipeline to the coast. So pull all of this together and you get the real picture behind the headline. It's not that Canadian oil randomly skyrocketed in isolation. It's a chain reaction. A war in the Middle East shut down a fifth of the world's oil shipping lanes and repeatedly reignited every time a ceasefire looked like it might hold, pushing global benchmark prices up somewhere in the range of 70 to 80% from where they started. The U.S. responded by draining its emergency reserve to one of its lowest levels since the 1980s just to keep a lid on prices, which is itself a warning sign for the next crisis. And underneath all of that, American refiners, especially the ones across the Midwest that were purpose-built decades ago to run on heavy Canadian crude, found themselves more exposed than ever because they simply cannot substitute that oil with something else on short notice. Add a 10% tariff into that mix, and you've got Canadian producers absorbing a real financial hit, even while American refiners remain just as dependent on their barrels as ever. That's really the story here. It's not a simple villain and victim narrative where one country is squeezing the other. It's mutual dependency under strain, tested by a war neither country started, exposed by a reserve drawdown that can't go on indefinitely, and complicated by a trade policy that seems to be working against the very energy security it claims to protect. Whether that gets resolved through a lasting Iran ceasefire, expanded Canadian pipeline access to new markets, or some kind of tariff rollback, one thing is already clear. The next time tensions flare in the Strait of Hormuz, or the next time a tariff decision lands on Canadian energy exports, watch what happens to Midwest refinery margins and gas prices at your local pump. That link between a shipping lane 9,000 miles away and the price you pay driving to work is not an abstraction. It's about as real and as direct as global energy markets get.